Hey everyone, welcome to the second edition of the Cashflow Chronicles Open Forum. I have Chris Walcher here with CollectCo. We're doing things a little bit differently this seminar. As you can see, the world of business changes quite frequently, so how we bring people on board, it's going to adjust based on who the right people are to talk and topics. So Chris, welcome. Thanks so much for joining, man.
Yeah, thanks so much for having me, Matt. Obviously, we go way back. We've collaborated on a number of different projects, and so exciting to see Cashflow Chronicles, really kick off for you. I'm already a fan.
Hey man, your content's great on LinkedIn, so anybody that isn't connected with Chris, definitely be in touch. He has some pretty creative content there. So, real quick, Chris, so your role as Senior Director of Sales there at Cedar Financial, how do you navigate between being aggressive from a debt recovery standpoint and maintaining that positive client relationships? I know that's a big piece of where your focus is there at CollectCo.
Yeah, man, really good question. And so I think the most important thing is comprehend that debt collection in today's world is not the same as debt collection in the 90s or even the early teens, So that word aggressive always kind of gets under my skin when I'm talking to clients or different kind of methodology approaches, just because it is really not the tactic to find the best success when you're pursuing delinquent receivables. So really what we're talking to our clients about at this stature is, I always like to use the expression LTV, lifetime value. In our pursuit to try to recover delinquent receivables, it's equally as important that we're preserving the integrity of the relationship that the creditors or our clients created with their customer base. Like, look, just because you are in collections doesn't mean you're a terrible person. Everybody goes through perhaps a hiccup, and it doesn't have to completely tarnish that relationship with a service that, quite frankly, was probably adding a lot of value and working for you. And so what our approach is we're amicable from the start. We want to be allies and supportive and coming up with any type of resolution process to get the outstanding amount paid, but also nurturing that relationship and really fueling in and leaning into, hey, look, do you want us to help you sign back up with the client? Or do you want to get on a pay to make current plan so that you can get access to like a subscription platform or a SaaS platform? So that's really our approach right now, is focusing as heavily on how we're recovering and making sure that consistency and diligence is playing through, but also on nurturing that relationship, because we know, especially in today's world, it's so hard to create a strong relationship with your customers. And when you get to that point, you don't want an outstanding bill to be the catalyst that knocks the whole building down.
Yeah, thank you so much for that. I think we can both agree that relationships are vital in the business world today. And basically with myself with trade credit insurance, and then there at Cedar, being around since 2017, I think we can agree the world and how you collect and how you work with clients changes quite a bit. The
So
good old
quickly.
days of sending somebody to collections, we're never going to talk to them. That's
No,
what neither of us
exactly.
does.
Exactly. I mean, look, I've been in this industry for 10 years, and from day one to right now, I can't tell you the amount of changes, the new adoptions of methodologies and technologies, which I'm sure that we'll get into later on. But yeah, man, it's an ever-changing, ever-evolving landscape, and those that are winning are staying ahead of the curve.
Yeah, I think leaders that actually have an open mind to new perspectives is super helpful. We're all busy, but just that sense, spending 10, 15 minutes just to say, hey, this is an option that could help. I don't know.
Exactly.
Relative to something you think you understand, but maybe if something has changed. So from a CFO's perspective, what are the key financial risks that are tied to unpaid invoices? And ultimately, trade credit insurance, then you have collections. As far as, I think we can agree there's a collaborative effort between the two of us in our
Without
work.
question. Without question. So I would say first is what we're seeing right now in the creditor landscape is I don't think that there is as much adherence to the potential risk performed upfront. Talking about trade credit insurance and even simplifying a process like trade credit just into having a really strong QC or due diligence, or how are you qualifying your customers to extend a line of credit or to open up a large business negotiation where you're talking about potentially a pretty significant pitfall if things go south. And so one of the first things that I would recommend for CFOs, controllers, anybody in an operational standpoint is I would pay homage equally to what you're doing up front to protect risk and mitigate risk as we see on the back end. Of course, it's super easy for anybody who has an outstanding balance to call a debt recovery agency and say, I'm about to be $1 million in the hole. My XYZ is filing for bankruptcy. I can't believe this happened. And of course, there's processes that an outfit like Collectco or Cedar Financial can manage. But if we just put that same type of emphasis and energy on the front end of mitigating risk, like I know, Matt, you with Allianz Trade, you guys are one of the premier providers of trade credit insurance and protecting people up front. And I think that that's the real differentiator, is just that sparse equal focus on being proactive rather than reactive.
Appreciate that. I think the one thing that everyone has a process in place, and with that process, there's going to be some level of risk when you absorb all the risk 100%.
Yeah.
There's never enough information about a company, point blank. And for both of our standpoints, we want to do what's best for that business on the front end. Hey, let's control the controllables.
Yeah.
At least pursue the variables that you simply can't control. I like to
I
think
like that.
we do.
Control the controllables. I like that.
Let's be honest, financial certainty, that's something that's great because cash is king, right?
Right.
I like to think of us as the oil between sales and credit, because how do we remove those challenges and give quick credit approval?
Right.
So real quick, obviously Cedar Financial has an international trade perspective, and Allianz Trade is a global company as well. So what's the variables on a collection standpoint from a global marketplace, especially in the collections world? And then kind of trade credit kind of pairs up a little bit to that.
Yeah, no,
Same
definitely.
standpoint.
Big question. So when you're dealing with delinquent receivables or debt recovery, particularly offshore or globally, the first thing is every single country has their own different rules and regulations and how do we operate, particularly through like the European Union. Obviously, there's regulations like GDPR, which is very different from some of the more domestic regulations we're familiar with, including like CFPB or FDCPA. So foundationally, I think that just having a really keen understanding on what those unique nuances in each country that you're trying to recovering in is prime for you to be able to find success. Like, for instance, in a lot of the East Asian regions, an effort like site visits is really popular for debt recovery, where in the United States, there's really not a lot of site visits that are being performed. Or if you look going back to like a Thailand or a Singapore, a lot of their addresses or their postal system is not as clear as, say, it is in the States or even in the UK. And so you've got to come up with these different mechanisms. They're really heavy on like phone call, SMS, text messaging. And so yeah, it really just whittles down to, again, understanding what are the common communication channels in any region or country that you're trying to collect upon, making sure you have a sound and valid understanding of what those regulations are, and then really just putting the pieces together from there. I mean, one of the like separators I'd say for Cedar is that, we're lucky enough to have actual local boots on the ground in over 170 countries. So it's not somebody sitting in the United States calling on a debt in, say, Nigeria. We've got someone who speaks the language, understands the language. They're familiar with the local community and obviously the regulations, and all of these kind of puzzle pieces put together are ultimately what I think has really kind of built that channel of success for us, just because we are able to provide a local presence for a global recovery.
Yeah, I think we completely agree from that standpoint as far as having an expert that understands the local variables in every country. I know in some countries, if there's a bankruptcy, you have to wait approximately a year to ever collect on the actual debt post-bankruptcy.
Yeah.
So if you're $2 million out after a Chapter 7 bankruptcy, what's that going to do to your business?
No, exactly. And just going back to trade credit and kind of the global landscape of receivables, I think that is the pocket for any, say, domestic entity that is operating offshore business ventures, call it manufacturing between the US and China, or really significant SaaS products between the US and the Middle East. That's really where the opportunity to take hold of trade credit insurance, protecting yourselves in a proactive rather than a reactive, I think that that's really where I would advise to see the spike in that level of protection, just because, it's 2025. There are so many unknowns. Somebody could put together a cookie cutter website, fabricate a whole bunch of documents. You're going, look, this is the real deal, only to find out it's a single person operation in a shack and you just sent across $500,000. So those nuances, they really, I think, is, again, particularly in the global landscape, that's where trade credit needs to come into play.
Yeah, I mean, you'd think you'd be surprised how easy it is to create a credit report and things like that just to pass the typical credit process. And then ultimately just, I'm the greatest company ever. And we call them shell companies or like ghost companies I mentioned at the past time.
That's right.
Also for reference too is when that AR is secured with trade credit, again, this isn't a trade credit plug, but the banks are actually going to lend against that foreign AR as well. So instead of going around a letter of credit route with trade credit, you can expand sales to a new country almost within 24 hours. And the banks will lend against that. You would actually know how the validity of the company and your risk is completely offset, both from a lending standpoint as well as from like a credit quality standpoint. So super important.
Totally agreed.
So have a wide array of questions here, Chris.
Let's hit it.
Just before we dig into anything you want to put on closing?
No, I mean, I think that we pretty much nailed it, especially in that global stratosphere. If you're not entertaining trade credit, or it doesn't even have to be an insurance plug, just the level of due diligence, like performing a real strong background. What's the asset history? What's the credit history? Having some of these fundamental QC checks are at least the starting points for some of these creditors operating globally to protect themselves on the front end so that you don't get the worst of the wrath on the back end.
Yeah, and to that point too, we had a 14-year high in bankruptcies this past year, and then just in January, it was up like 16% versus last year. So with the new administration, tariffs, lots of uncertainty right now. So the ever-evolving constant risk in business is even higher than before. So this could be reciprocal, but David actually asked, how should we adjust our credit terms to reduce risk without negatively impacting sales growth? What would be some advice you have? It's the fine balance, the oil, right?
That's the question of the game, right? Look, obviously, having all of the tools available is the first start, whether it's just having the tools to be able to run the background on any type of company, having a contact to be able to employ credit trade insurance if you need to. So having the tools is the first step. I would say the second step is really creating that niche criteria of when to employ which of those options. Let's be honest. You can't just run across the board and make all of your customers sign a personal guarantor right from the onset. It's super off-putting for a lot of your new customer base, and you're trying to create a sound and awesome customer journey. So you don't want to trigger those red flags. However, when you're talking about really sizable deals, anybody operating in that world would understand that there needs to be some type of risk mitigation. And so it doesn't have to be as forthcoming or blunt as, hey, I don't trust you, I need you to execute this, or hey, I'm going to go and grab trade credit on this opportunity just to protect myself. But certainly, man, there are ways to whittle in those necessities for mitigation without completely sounding all the alarm.
It's funny. That's common sense, but I think a lot of companies we're good. We have a process in place.
Yeah.
And then I track bankruptcy selfishly, and I see they're affected by a bankruptcy. If you have $2 million out on AR, for example, what would it mean if you're paid 30 days late on that? You have no leverage, and your bottom line, your cash flow is tight because it's $2 million in AR that's just sitting there. Or what if they file for bankruptcy? What controls do you have? Even chasing financials back and forth, that's a slippery slope, like you said.
Yeah, man. It goes up and down the gamut. And that's what I mean. It doesn't have to be as stringent as personal guarantor or we're putting an insurance policy on this business deal. But having those tools available to you and really having that internal proactive QC so you've got all of your nuts and bolts together. If you do by any means need to say file proof of claim in another country because of a bankruptcy or dissolvement, you've got those keystone pieces put in place so that you're not just operating on the reactionary end, which unfortunately I find is the case with most of these people that fall into these holes.
Nobody wants to spend money until they're affected. That's the hardest part.
Yeah.
And that's why I always say, if you could just have one line item on your balance sheet that says, hey, we're not going to take any bad debt for this set cost, and we can sell more, why not go down that route? Because there's so many variables, it's hard to predict financially.
No, I agree.
Much less than a bad debt reserve.
I agree.
Same approach from you from a collection standpoint. So what are the top industries on the B2B space that you're seeing that are facing some of the top payment risks? And I know what I see in my space. What are you seeing predominantly right now?
Man, so in the commercial B2B world, I mean, manufacturing is always kind of at the forefront of that, especially just because they're obviously big ticket items. For something like a manufacturing deal, it's not you can't just return and refund. Oftentimes, these are special, unique made, whether it's for operating, XYZ, whatever it could be related towards. Manufacturing is huge in terms of a sector that should really apply a strong risk mitigation QC check. I would, in that particular landscape, recommend personal guarantors or trade credit insurance, just because the opposite end of the stick, if things fall south, it's just tremendously consequential. Going back to, what happens if $2 million is paid 30 days late? That type of limited AR capacity is really the make or break for a creditor. And so you don't want to put yourself in those type of weeds. Outside of that, I would say, aside from manufacturing, another really strong commercial area that we're seeing is, it's just escaped my mind. It's coming back to me. Wait for it. Boom. Advertising and marketing deals, especially for people that are creating these really, really robust market plans, talking about paid advertising or even sponsorship. Like, we work with a number of different clients that are bigger names, and so they've got different mechanisms and deals where an event wants to plaster their logo and say they're the sponsor. And so some of those deals where it's less product but more service, advert affiliated, again, it's just so easy for some of those quote unquote ghost companies to go missing after you've already given all these tools for success. Two really big ones that I would probably keep an eye out for.
Because legitimately, who says no? We don't want to sell to that company. It's a big deal,
right?
I mean, it's and if it's a time sensitive issue as well, it's terrible. The credit and sales team once again have to butt heads quite a bit, which is kind of a shame. And there's ways to streamline that process. And ultimately, yes, you're spending money up front, but based on what we see in the industry, I would say specifically manufacturing, the late payment trend is increasing dramatically because everyone's facing tight margins, supply chain challenges, staffing issues. There's so many variables in place. So it's really just, what does your liquidity look like if somebody pays you 5 days late? Oh, well, we have a good relationship. That's great. But what does that tell you is going on behind the scenes about that company?
That good relationship seems to be getting them more often than not. I'll tell you that.
You'd be surprised how frequently I'll have someone says our credit line's $300,000 on 60-day terms. We've been doing business with them for 25 years. I take it to our underwriting team, which has the best data available, legitimately 30 mercantile reports, things like that, some proprietary information. We can't support that credit line because that customer's only paying him and a few other payees. So it's helpful to know kind of what's going on behind the scenes from that standpoint. And then, of course, if a bankruptcy ever happens, preferential payments are a factor as well.
Right.
Which basically means after bankruptcy, they can claw back payments that you already spent. So very important. So any other thing? We have a lot of questions. I want to respect everyone's time.
Yeah, no worries.
Is there anything else you can come up with as far as just tips and tricks?
I mean, on that note, there's one thing that comes to mind, and I'll play devil's advocate the other side of the table. So, one, I believe that most people are inherently good, especially in a commercial operation, right? So if you are one of those inherently good characters, the best advice that I can give you if you're drumming up towards a bankruptcy or not quite bankruptcy, but you're experiencing a real financial hardship, the way that you can secure the relationship is communication. A lot of the times, if you are on, say, a net 60 term, if you are on a net 60 term, but you're communicating with the creditor an extra 30 days, even an extra 60 days, getting you into the scary territory of 120 DPD, it makes a lot more cohesion and a lot more of the flexibility realistic. You just got to keep communicating. And on the creditor side, I would say, if you have tangible evidence that there is a financial hardship, but your owing party is communicating with you, well, I mean, for me, now me as a creditor, I have an obligation to try and remain flexible. Let's say if you're supposed to give me, K a month over month for XYZ, I would encourage creditors, especially if those owing parties are communicating, be flexible. Hey, you can't do 50 this month. Well, what can you do? Let's keep a positive transaction history. Don't ghost me. And as long as you keep communicating with me, I'm going to do what I can to be able to be flexible and negotiate with you so that we get to the other side of this unscathed. So that's what I would say.
Thank you so much for that, because I agree 100%, because no one inherently is a bad person. And if someone doesn't communicate, it's because there's some level of uncertainty, or no one likes to say, hey, my financials aren't looking great.
Yeah,
Because if you stay ahead of it, it's going to turn out much better than after the fact, because you legally owe something to somebody. So as long as you
absolutely.
communicate appropriately on both sides of it, because nobody wants to damage a relationship.
Right.
So 100%. So once again, I appreciate everyone for the time to jump on here and listen to us. This is, as mentioned, this is a community-based approach. So Chris is the second lucky individual that came on board, and I'm super pumped he was able to join us. If you have any feedback, anything you want to discuss, please let us know. I'd be happy to get something going, and let us know any questions you have in the future. Thanks so much, Chris.
Hey, thanks, Matt. Love what you're doing, man. Like I said, I was a fan from day one. Cash Chronicle is honestly a landscape that other finance professionals or anybody working in our world should really lean into, just because even from the first episode, you just get to hear a smattering of insights from professionals on what their day-to-day is, what their real insights are. I mean, to be fair, that's what makes all the difference in the world, is that continued value, getting insight from actual other pros that are boots on the ground. So couldn't be more of a fan of what you're doing, brother.
I appreciate that very much. As Scott Harris said the first time, Cashflow Chronicles, a pretty broad spectrum.
Right.
Because obviously cash runs the world. So definitely appreciate that, man. So thank you, everybody, for jumping on board, and more to come here in the future.
Bye, everyone.